2017 was a great year to be an investor in risk assets, with equities up over 20%, high yield at 7.5%, and corporate bonds at 6.4%. While in higher quality treasuries and mortgage-backed securities, you effectively only earned your coupon with returns of around 2.5%. We've been in a position to take advantage of this strong performance with significant underweights to treasuries and MBS throughout our portfolios, which helped us continue our historically strong performance.
The investment-grade corporate market performed very well in 2017 with a total return of close to 6.5%. Compared to 2016, volatility was lower, the default rate declined, and there were more credit rating upgrades than downgrades. The improving U.S. economy, as well as those in Europe, China, and Latin America, helped companies grow revenue, and corporate actions were muted because of the uncertainty related to tax reform. It was a very good backdrop for corporate credit. Companies continued to issue a record amount of debt to take advantage of the strong demand from traditional investors, as well as foreign investors and ETFs and mutual funds.
Structured products did exceedingly well in 2017, much like the other spread sectors. A combination of spread compression and just overall yield really led to some outperformance that helped us outperform our benchmarks. Within the sector, commercial mortgage-backed securities did the best. A combination of solid property appreciation and improving cash flow certainly helped the sector. Surprisingly, the second best performing sector was agency mortgage-backed securities. Despite the Fed removing some of their influence, that sector did quite well. It had a lot to do with the fact that interest rates really not moving much. That low interest rate volatility really helped the sector quite a bit over the course of the year.
Well, during the course of the year, the uncertainties related to tax reform were hanging over the market, so we repositioned our portfolios to an underweight bias to the sector by reducing exposure to maturities 7 years and shorter. We also maintained an overweight bias to the longer end of the curve to take advantage of the excessive steepness in the curve. Our repositioned portfolios did very well as the yield curve flattened at 85 basis points over the course of the year, and 10-year yields fell by 33 basis points, which outperformed taxables. 10-year Treasury yields fell by only 4 basis points.
As we start 2018, the spread or risk premium to hold corporate credit is lower than it was a year ago. We expect economic growth and low inflation to remain supportive for fundamentals and keep volatility low, but we expect companies to start re-engaging in M&A that will likely be partially or fully debt financed given very low interest rates today. Another headwind for spreads is related to central banks pulling back on quantitative easing and the Federal Reserve increasing interest rates. These actions are likely to reprice assets and could change the supply-demand dynamics that have been very positive for corporate bonds. So in summary, while our fundamental view is constructive, valuation is not compelling. Our expectation is for modest returns from the corporate market in 2018, and we believe it will be a year where credit and sector selection drives performance.
In 2018, we think it continues to warrant a significant underweight to agency mortgage-backed securities. Mostly we anticipate the Fed exiting the market fully by the end of the year, hence probably putting pressure on spreads. Alternatively, on the non-agency front, we still believe that represents the best value within our sector. A combination of 6% price appreciation on underlying properties and really solid underwriting leads us to believe that's going to be a really great solid sector for us in 2018.
But looking forward to 2018, we're expecting very favorable technicals to develop throughout the year. Demand technicals are expected to be very strong with over $445 billion and reinvestment flows of coupon calls and maturities. While overall supply is expected to fall by 23% relative to 2017. Overall net supply is expected to hit an 11-year low of negative $120 billion. Consequently, we have a constructive outlook for the sector and we expect it to perform well relative to taxable alternatives.
The first Fed rate hike was in December 2015. We've had 5 hikes and the Fed is expecting 3 more in 2018. Since December of 2015, the 30-year Treasury has fallen 20 basis points, while the 2-year has risen by 100. This flattening of the yield curve happens every time the Fed enters a cycle of tightening, and it was easily predictable. However, we haven't seen a Fed tightening in the face of significant corporate tax cuts before. My driving instructor told me to only use one foot while driving. Unpredictable things can happen if you give it gas and brake at the same time. Risk market investors have priced in strong future performance of the economy given the tax cuts, while us bond guys have priced the Treasury market with a view to the economy slowing as the Fed raises its funds rate. With spreads tight and risk assets expensive, this is no time to chase yield, but rather we recommend using the aggressive bids in the market to trim overweights or significant risk positions. The cost of moving to a less risky portfolio is nominal, and this is a great time to rebalance your portfolios. We think that individual security selection and a focus on risk will prove to be the right call in 2018.